Well, welcome everyone to today's webinar, Getting Ready for 2024. My name's Matt Conradi, and I'm Head of Client Advisory here at Netwealth. I'm joined today by two of my colleagues, Ian Barnes, who's our Chief Investment Officer, and Jared Lyons, who's our Chief Economic Strategist. Today, what we wanted to do was help you to think about how you can be prepared for 2024, to understand what is going on in the economic world, what it means for markets, and how we should think about planning for the future, and what we can control and what we can't control as well. There's a few bits of administration I'd like to point out before we get started, though. You can ask questions for today's sessions, and I know a number of you submitted some in advance. If you'd like to ask questions during the session, please use the chat function and go on to Netwealth Q&A, type in your messages there directly to them, and then they'll be passed on, and we will have time for those questions at the end of today's session. I think what we are here today to do is review 2023 and think about 2024. 2023 has been certainly an interesting year where there's been lots going on for markets, for economies. We've been seeing changes in monetary policy. We've seen central banks around the world trying to fight inflation. What's that meant for economies? What's that meant for companies? What's that meant for individuals when we're thinking about our costs of living and how we balance our plans into the future? I think despite some of the negative narrative perhaps that we've heard and some of the challenges that we've faced, actually what we've seen this year is that markets and portfolios have been surprisingly resilient. And when we look at our multi-asset portfolios, we'll touch upon performance. But broadly speaking, we've seen positive moves this year, which is very encouraging despite everything that we might have seen and heard. From a planning perspective, there's been some major changes that have come in UK taxation that we'll touch on later on, particularly around pensions and the lifetime allowance, which people are just starting to understand. And we need to also think about our setups and what's changed there, whether that be around cash rates, interest rates on mortgages and so on, and how we should be adjusting our plans to reflect this slightly different world that we're in at the moment. So what we're going to do now is start to think about that world, what it means from an economic perspective, what we've seen this year, and what we might expect to see in 2024. So I'm going to start by handing over to Gerard, who's going to talk about that.
Thank you, Matt. I would like to focus on three key areas. First, the major themes for 2024. Second, what's going to happen here in the UK, and third, the implications. So the key themes. I think the big question is, where are we in the economic and the political cycle? It's been my contention for some time that we are seeing a shift from a focus on inflation to a focus on growth, and that then will be followed by a focus on debt. So in many respects, 2023 has been the year when we focused on inflation. In my view, the focus in 2024 will be about growth and indeed the weakness of Western economies. And then in 2025 or so, it will be a return to a focus on debt. Plus, on top of this, post the COP meeting that's just finished, the next year we'll see the energy and climate change debate move to a focus on the energy transition. And then on top of this, politics and geopolitics will become a major theme as we move through the year. But let's take the inflation picture. Inflation peaked at the end of last year. Through 2023, it has decelerated, but core inflation has proved stubborn in Western economies, largely because of second-round inflation effects, as workers have tried to make up for inflation by pushing wages up, and also as firms have tried to boost their profit margins. But in 2024, those second-round effects will dissipate because of economic weakness. But it's important to stress that what caused this inflation shock in the West has now been reversed. This inflation shock of a few years ago was triggered both by supply-side factors and by very, very poor monetary policy. Both of those have now been changed. Supply-side factors have now disappeared post the war, post the pandemic, and monetary policy has gone from being too loose for too long to indeed being too tight now. But on top of that, it's important to stress that the last quarter of a century has seen four global factors drive inflation down. And importantly, two of those four global factors have changed. That implies that in the future, inflation will likely settle at a higher level, say 3%, rather than the 1 to 2% we saw before the pandemic. The two global factors that have changed is that globalization has been replaced by fragmentation. Firms are not just doing everything based on cost reduction, taking account of risks and other factors has come to the fore. And the other global factor that's changed is that wage shares, which was pushed down in the West, have now been reversed and wage shares are starting to rise. On top of that, though, we do still have technological change and financialization. But the message is this, that inflation, in our view, will decelerate over the next 6 months, probably bottom next summer at around 2% and less, and then start to trend higher into 2025 and settle around 3% or so. But just to finish on inflation, while markets are now optimistic about the prospects of inflation decelerating further, the general public in the States and in the UK very much focus on price levels, not just rates of inflation. And here in the UK, for instance, the level of prices is 22% higher than at the beginning of 2020. So higher price levels have eaten into living standards. Obviously, for the general public as well as the markets, two key areas in the next 12 months will be oil and food prices. Oil prices have now stabilized at a relatively low level compared to recent peaks. On food prices, importantly, they're now 14.4% below their peak of a year ago, or the level of a year ago. Although there is a wide range of changes, dairy prices are down 23%, sugar prices are up 47%. So probably further volatility is likely there. And that's the inflation message. As we move into next year, growth comes more to the fore. A year ago, the markets were too pessimistic about the West. In contrast, they were very optimistic about China post the unlocking following the pandemic. Things in the last 12 months have turned out to be the other way around. People became more pessimistic about China as the year progressed and more optimistic about the West. What about now? The likelihood, take China, is that the future trend rate of growth in China will be lower than in the past and more volatile. But in 2023, China probably grew around 5%. In 2024, expectations, in my view, should be centered on 4.5%. So steady, but not dramatic. In Western economies, what we have is this. The major economy, the US, is moving from a soft landing to softer economic growth. Indeed, the Fed this week forecast that the rate of growth in the States would be, after 2.6% in the last year, 1.4% in the next year. And that's even with policy easing. The world's number 2 economy, China, I've mentioned. The world's number 3 economy, Japan, is doing okay, growing at a modest, but by recent standards, good pace for Japan. The euro area is in recession and faces a very difficult start to 2024, while the UK economy is stagnating. To conclude the first part, it's also important to stress that as we move through the next year, that economic weakness and dissipating inflation shouldn't take our mind off some of the other structural issues. The underlying debt picture may be helped over the next 12 months by the fact that nominal growth and inflation allows debt to GDP ratios to come down. But by the end of the next year, we face the reality that debt levels are still high and that key relationship between growth and interest rates is not looking good. Growth will be still modest and interest rates are likely, even after falling in the next 12 months, to be at a higher level than the rates of economic growth. So it's a difficult debt backdrop. And the important thing about that is it limits, therefore, room for maneuver for policy. The energy transition will be another big theme over the next 12 months. And then there's politics and geopolitics. Geopolitical issues, we know the ones to watch. Taiwan, obviously events in the Middle East, and Ukraine. What about politics? This coming year is an important year in terms of global elections. Obviously, there's the US, but don't forget that this year we'll see the first time that India and Pakistan go to the polls in the same year. That's important, but often overlooked. We now have a G3 world. Group 1 is America and its allies. Group 2 is China and its allies. And Group 3 is the non-aligned group, or as they're called in Britain, the middle ground powers, led by the likes of India. So keep an eye on those political changes. And then here in the United Kingdom, we have the general election, although in theory it could be held as late as January 2025. The lesson from the last 45 years from Prime Minister Callaghan and Prime Minister Brown is that if you think you're going to lose, you stay in power as long as possible. Some people speculate that there could be an early election, helped by tax cuts in the spring budget and by inflation bottoming around May or June. That's possible. But my guess or expectation here is a later election next autumn. What will happen afterwards? Well, the Labour Party is very much focusing, as Brown and Blair did in 97, in focusing on fiscal frugality. The UK has only had 5 years of budget surpluses since 1971. 2 were with Nigel Lawson when he was Chancellor, and 3 were with Gordon Brown when Labour won in 97. Of course, we then went from famine to feast in terms of public spending. But Labour is planning to be cautious. But of course, if they have a big majority, if they were to win based on the opinion polls, we might see more radical policies. But we will develop this further in the year ahead. In terms of the states, to conclude on the first part, obviously the current polls suggest it's Trump v. Biden. There will be no change in monetary policy in terms of Biden or Trump. The Fed will still be on its own agenda, which points to rate cuts. I mean, no political change in terms of the impact on monetary policy. But an important part of the US economy and its recovery over the last 12 months has been the important role that fiscal policy has played. The US has a huge budget deficit. Under Biden, that would continue, focused on the IRA bill. But if Trump were to win, one would expect that IRA bill to be replaced by a focus on tax cuts. So the fiscal agenda still will be positive for US growth, but in a very different way. The interest rate picture, though, would be on an autopilot based on the views of the Fed. So to conclude the first part, there are some big themes: inflation to growth to debt, with 2024 being very much a focus on growth. On top of that, the energy transition, and don't overlook the politics and geopolitics. Second part is, what about the UK? The UK economic situation is not particularly good. The economy has not really recovered from the 2008 global financial crisis, while the public finances have not recovered from the pandemic. Before 2008, the trend rate of growth in Britain was 2.4%. The economy doubled in size, in real terms, every 32 years. The official forecaster, the OBR, thinks that the economy's trend rate of growth is now 1.6%, doubling in size every 45 years. But the economic consensus, including ours, is that the trend rate of growth is lower than that, and the economy might take 60 years or so to double in size. That's the longer term challenge, and that's why there's limited room for maneuver on fiscal and other policy measures. But what about 2024? There are 3 factors that suggest a recession, and 3 factors that suggest we'll avoid a recession. Let me tell you each of these. The 3 pointing to recession are: first, a number of recent indicators, including the purchasing managers indicators, which are in recessionary territory. Second is that monetary growth and bank lending are in negative territory on a year-on-year basis. Financial conditions are really tough. And the third is that monetary policy tightening from 0.1% rates up to where they are now, 5.25%, takes some time to feed through. And maybe as much as half of that tightening has yet to fully impact the economy, although the Bank of England thinks it will have impacted by the end of this year. I think they're too optimistic on that. So those are the warning signs. Against that, 1, the economy has proved resilient, with the jobs market holding in pretty well, even though it's now softening. Second is that over the next year, inflation will decelerate and wage growth will allow real incomes to pick up. And the third factor, which is the key as to whether we avoid a recession or not, is that there is room for policy maneuver. I think that there will be some fiscal stimulus in the spring budget. It won't be much. But on top of that, monetary policy does need to ease. The markets are discounting at least a couple of rate cuts over next year. I think that rates should have peaked at 4.5%. We're now at 5.25%. The bank will be reluctant to ease early in the year because some core measures of inflation are stubborn. But as we move through the year, interest rates should be cut down to 4.5% at least by the end of the next year. That should allow the economy to just keep its head above water, but the best way to think about it is stagnant growth. Third and finally, the implications. First is a word of warning in some respects. At times of uncertainty, as we are now in, one would expect economic forecasters to be actually quite wide. What actually perversely happens is that because of the uncertainty, the forecasts tend to coalesce around a similar level. That suggests that forecasters are confident about what lies ahead. anything but. So look at these forecasts with a degree of caution. Second, at a time of uncertainty, don't lose sight of the underlying structural factors. We have structural themes that we think are important in our view here at Netwealth. One is the shift in economic power to the Indo-Pacific, stretching from India in the west to America in the east, Western Europe, including the UK, facing difficult growth. But another key theme is in the next year, policy will play an important part. If there's limited room for fiscal maneuver, then it's up to monetary policy and central banks to act. But ideally, they shouldn't cut rates aggressively back to the low levels they were at before. But certainly there is some room for policy stimulus. And that will probably allow markets to start the new year in a positive frame of mind, expecting policy easing. But as I've indicated at the beginning, it's a very much a shift from a focus on inflation to a focus on growth, and the challenge is where that growth is going to come from. I'll now pass over to my colleague, but before I do that, just to say that on the Our Views section of the website, you can actually follow my views on a regular basis. Thank you, and back to you, Matt.
Jared, there's a lot of different things to cover there. Certainly some notes that I took were thinking about inflation having peaked, but likely to be higher for longer in the future at slightly higher levels. And also that interest rates will likely be coming down next year. And I'll be talking about what that might mean for your financial plans in 2024, how to think about that. But next, what we're going to be doing is bringing in Ian to talk about what this is all meant for markets and portfolios. For those of you that want to watch this back, remember this session is being recorded because I know there's lots of content being covered. And remember, you can ask questions. So if you have any further questions, please do put them into the chat function to Netwealth Q&A, and we'll make sure we cover them at the end. There have been a few in here. If there's anything we don't manage to cover for you, you can always send questions through to advice@netwealth.com, and so make use of that functionality as well whenever you want to. So let's bring Ian into the conversation now. And start to think about what this has all meant for markets and portfolios.
Thanks a lot, Matt, and thank you everyone for joining us. I think I'm going to spend a little bit of time just reminding everyone about how we think about investing, and then update on what's been driving markets to date, and maybe a little bit about the future. So, Matt, if you wouldn't mind sharing a couple of the slides. Just to remind everyone that on the first slide, we can see the way that we think about managing portfolios. So we run 7 different risk profiles in each of 4 portfolio ranges. 3 of them are currency-based, and then there's a socially responsible investment strategy as well. So it covers a range of different investment risk appetites, but the approach is very consistent, trying to take efficient exposure to different market factors and try to navigate our way through an often changing market environment, but in a way that delivers those market returns effectively to client portfolios. So moving on to the next slide, if we think about what has been going on in the past couple of years, well, as Jerry has mentioned, the economic impact of policy tightening has been pretty dramatic, and is starting to be ever more clear how the global economies are starting to respond. We know this has been a million miles away from a normal economic cycle. Extreme monetary and fiscal policies nice and easy during the pandemic, and then followed by a sustained coordinated tightening cycle. The slowing of the global economy is most notably clear in Western Europe. But I think one thing that we can be confident in is that resilience of the labour market in different countries has meant that the broad-based recession that people were expecting this time a year ago has not materialised across the board. So when we think about different scenarios that face markets in the few months and quarters ahead, the team try to imagine how different assets are going to be positioned to respond to this changing expectation in economic performance. So for now, we're seeing this benign disinflationary period, which is generating an environment that's been very positive for a range of different asset classes. And it's a fascinating time to be communicating today in the midst of a very busy week for central bankers. But importantly, the activity of that tightening process as Jerry says, has bankers a lot of room for maneuver. So the volatility that we've seen across fixed income markets over the past couple of years as interest rates have been hiked has led now to an improved outlook today. We can see this most clearly at the shorter end of the interest rate curves, where 2-year US Treasury government bonds yield around 4.3%. The UK is about 4.2%. Most clearly, you can see in Germany, where the 5-year government bond yield has moved from 2.9% at the end of September down to below 2% this morning. So a really significant move there. That's reflecting this slowing growth profile, but more importantly, that central bankers think that the passing of immediate inflation has been tempered. Now, on the face of it, equity markets have been pretty well supported by a resilient corporate profits picture. Yes, there have been areas that have been under pressure, but headline equity indices have done pretty well, and we can see that focus on that in a little bit of a moment. There are areas where a lot of pessimism reigns, and that's creating a lot of value opportunities. And when we think about different asset classes, it's very clear to us there's a big sort of dichotomy between places where there are cheap valuations in places that have been unfavored versus areas that have been sort of very well supported. And the interesting inflection point we might be seeing just at the moment is that people are starting to gain a little bit more confidence that some of those cheap valuations are going to have a reason to be unlocked. And that's going to be positive for a wide range of different asset classes. So, Matt, just going on to the next slide, I wanted to show something that I thought really captured the changing environment as clearly as possible. Now, this is the yield that's available on US 10-year government bonds, so the safest typically, but we're taking future inflation into account. So what the market's expectation is for future inflation, or how much it costs to protect against future inflation. And you can see that that steep shift over towards the right-hand side of the page, going from -1% of a real yield, a post-inflationary yield, up to +2% per annum, is a dramatic change. And that's really what that was what brought the volatility through to different investment markets. What it does mean is that not only is this era of free money is over now, but you are getting a meaningful return on safe asset classes. And that shift has transformed the opportunity set across the board for a wide range of investment opportunities. So it's a good starting point to be thinking about how we can invest in the future. On the next slide, when we think about what performance has meant across the board, we know that 2022 was a difficult year for different capital markets. Yes, it was true in fixed income, but also that volatility within equity markets as well. The experience of 2023, as Matt said at the very beginning, has consumer sentiment pretty weak, but that has masked a greater level of reassurance among investors that the outlook is not too bad. So the best asset class so far this year has been Eurozone equities, and that I think is symptomatic of people being overly focused on a worst possible outcome for the Eurozone. We know that the outlook is pretty weak for growth, but assets had priced it pretty strongly. So hedging our European assets back to sterling has given that a little bit of an extra boost and has delivered strong returns. The FTSE on the left-hand side has trailed. For us, it's an important reminder again that the underlying exposure in different instruments is not necessarily driven only by the regional perspective, but also the types of industries that the investments are focused on. And the really key thing for us to remember is that taking the 2-year period as a whole, 2022 and 2023, the FTSE 100 ETF that we invest in has been the best performing asset on our portfolios over that whole period. So It's still had room carried over from last year, the strong performance to beat European equities, but also the US exposure as well. So despite the contributions to returns from the Magnificent Seven this year, hasn't quite caught up. Gilt markets have found this a reason to sort of stabilize, with higher yields starting to offset some of that volatility, which is great. But anything that's more exposed to the commodity cycle has really struggled. Gold has done better in an uncertain environment, and is even doing okay now as people think about the yields on offer around the world just sort of starting to narrow. The clear challenge, however, for I think investment markets as a whole has been that underperformance of emerging markets equities. Now they have really underdelivered people's expectations of growth, and the derating of the earnings that are being provided by emerging markets has really come as people start to worry about structural challenges within the different economies, notably China, but also geopolitical risk, which has been bubbling away under the surface. The last point I wanted to make was just that the SRI portfolios socially responsible investment portfolios have struggled to keep up with our core approach, and that's because some of the factors over the period we're considering, not necessarily this year, but in slightly earlier periods, have been out of favor. And clearly, an impact of there has been the energy pricing, where you tend to have less exposure to carbon generating assets within strategies focused in that particular area. So that's the context of returns so far. If we think about what that's meant for the Netwealth portfolios on the next slide, we use this slide just as a bit of validation because it comes from an external source. And we use a group called the Asset Risk Consultants, so ARC. And what they do is they monitor all of the strategies in place, run by all of the leading wealth managers in the UK. And here they compare the risk being taken on portfolios along the bottom axis, and then the returns being generated on the vertical axis. And so clearly you want more more returns for less risk. So you want to be up towards the top left-hand side of the piece. And I appreciate that some of the graphics might be a bit hard to pick out here, but effectively the red dots are the Netwealth portfolios, and all of the black dots are the wider peer group. And so we're very happy that we're consistently ticking up there along the top of the band. We never expect to be beating the index by miles year in, year out, because of our sort of very core process of just focusing on efficiency and sensible allocations, not taking big stock bets, but you can see that it works through time. However, if we think about how that experience is not necessarily delivered just in a straight line, on the next slide, we're trying to think about things a little bit differently. So this is a little bit more colorful, but this the previous slide shows the experience from investors from the start. We want to take the opportunity here to think about people who've been investing with Netwealth over different time periods. And we can look at those different time periods in two graphics. On the left, each of these boxes represents the performance of a particular portfolio over a given time period. And so green is shown where you've seen positive returns, and red is where returns have been negative. Now, I think it paints quite a striking picture. The first takeaway for me is that investment over time really does work, that you get positive returns investing over time. You see a nice strong performance in over the past 1 year, and then extending over to the right, it's also green. But there's that clear notable bar of red in the middle, where a number of the portfolios have had negative returns. And we recognize that some clients have been invested through that period. But what reassures us is that when we think about the long-term history of investment returns, a negative 2-year return, particularly in lower risk asset classes, where you might feel that a little bit more, is very rarely repeated into a forward-looking 2-year return. And we can provide a bit more detail to that if people want to investigate a little bit further. Taking that experience of the overall market outcomes, we also think it's important to see how that compares to the wider universe of different managers. And this is where that ARC peer group comes into play. And you can see that, again, if you have all of these different time periods and portfolios, you can see that a green box, which represents performance above the peer group, is much more common than those very sort of individual, unique red boxes, which show the returns where we've been behind that ARC peer group. And for the sterling portfolios, it's every single box, so 30 out of 30 periods or points of comparison, you can see outperformance from the portfolios, and even those slight red ones are actually just very marginal negative relative returns. And I think what's important to remember is, and why we can take reassurance from that, is that the rationale behind this outperformance is the way that we're thinking about managing people's investments. We're not trying to point the portfolios in a particular direction, whatever the conviction we may have in different outcomes, but recognize if we build in a level of uncertainty into a range of different forecasts, make sure we've got lots of different asset classes that can respond in different ways, different outcomes, but do efficiently, then we're much more likely to win through time than people who put all of their eggs in one basket, if you like it. So I thought it was important just to touch base on that performance experience. Matt, if you show the next slide, which gives the more sort of formulaic numbers that we need to express, and you can look over on the right hand side of that column where you have the annualized since inception numbers, and that gap between ourselves and the peer group just continues to compound wider. So overall, it's usually about 1% to 2% per annum outperformance through time, which we think is important that people are able to participate in, as well as the benefits from just investing more broadly. I was going to leave it there, Matt, and hand back to you, but very happy to answer questions at the end.
Great, thank you very much, Ian. Another good example of what we've been doing in portfolios, what that's meant for markets, and helping us digest what to do going forwards as well. Because what we wanted to do now was take stock of the economic outputs, what that's meant for portfolios, what it's meant for markets, and then think about people's individual plans and what they can do to make a difference. So Ian mentioned our approach and being sensible about the way we think about making investment decisions, making sure we're giving core exposure in an efficient way. And there are similar things you can do from your financial plans to make sure that you are controlling the controllable elements of planning and of investing, and to make sure that you are getting the most out of what you're doing. But we also need to take stock of what's happened in the world, what's changed, and what that might mean for different plans as well. So I'm going to share my screen now again and pull up some slides to think about planning. And when you're thinking about 2024, it's always a good time at the beginning of the year to start by just taking stock of where you are today, but doing that in the context of what's happening in the world and where we are. Because if I think about talking with different clients, talking with potential clients, not everyone has a clear picture of where they stand. What are their assets? What are their liabilities? What income are they getting? What expenditures are they facing? And what may be changing in those expenditures over time? What inflations are they facing? And then think about what's happening in the world and what might have changed since the last time you looked at this. So if I think about cash, for example, not only does it matter how much cash you've got, we've been in a period of time where there was very little return on cash. There's now a return to be achieved on cash, but making sure where that cash is allocated is really important. You want to make sure you've got cash getting a return in a place where it's easily accessible, because the role of cash in a financial plan is to allow you to take risk in other areas. If we've got inflationary risks out there, we're pretty comfortable that cash is not going to beat inflation through time. As Jared pointed out, and Ian echoed, interest rates are falling. The expectation for interest rates in the future are not to be that cash rates will be giving you this 5% or so returns you're seeing today in a year's time or 2 years' time. So it's really important to make sure that your long-term pots, maybe your pensions, it might be ISAs, are striving for returns that exceed cash rates that exceed inflation. What else in the change of interest rate means is we need to think about liabilities. If you've got mortgages, loans, credit cards, payments, and so on, the interest rates there, particularly on mortgages, will be moving up substantially. Now, you may not have felt that yet. The nature of the way that interest rates on mortgages work in the UK is lots of us have fixed rates that take time to roll off. But if you're moving from a 1% or 2% rate to a 5% rate, you need to be clear whether the best thing that you can do is pay down debt or invest that money or save that money. But certainly you want to avoid scenarios where you've got an interest rate on a mortgage and you've got money in a current account earning virtually nothing, because banks are still not really passing on interest rates in cash accessible current accounts. You definitely don't want to be locking in that. Apart from elements that are there to give you that safety, to give you that flexibility as well. I think thinking through your expenditures and inflation is also a sensible thing to do, not only today, but planned expenditures in the future, because those are your goals. For most people, this is the objective, is how am I going to meet needs in the future, whether that be retirement, whether that be school fees or so on. And expectations on inflation are also important there. So if you've got a cash flow need in the future, and we think that inflation is going to be settling at a little bit of a higher rate, again, it's important to make sure you've got assets that are trying to meet that liability in the future, those cash flows in the future that have a chance of keeping up with that inflation as well. So taking stock of where you are today and thinking what that means for your plan is really important. It's not the simplest of exercises to go through this and translate this, which is why we have advisors on hand to talk to about this. We have some tools that you can use as well for modelling and planning to think into the future, to think about what it might mean for returns and so on. And through the course of this year, we increased, for example, our inflation expectations in the long run. We also increased our return assumptions as well from where they were historically because of what's happened to interest rates. And that needs to be factored into your wider plans so that you can understand the different benefits. There's some other things, though, that you can keep stock of and control. And I think this is really key. So when you're thinking about your plans, you need to consider these things. And some of them are driven by markets and some of them not so much. The first thing to be thinking about is what you can control and what you can't control. Market performance in any given period is not something you can control. What you can rely on is some of the things that Ian was talking about, which is in the medium to long term, the probability of having positive returns from investing increases considerably over time. But in any given year, we can't say with certainty what will happen. We might think that conditions are improving. Perhaps they're positive for markets if we see interest rates falling. That might be positive for equity markets, for example. We start with bond yields higher. The probability of getting a positive return on bonds is also increased. But we can't say for certain in a given year. So lining up your plans with the level of time horizon to increase the probability of getting positive returns is important. We also know with inflation that investing is broadly the best way to beat inflation, which is unlikely to keep up with inflation through time. That's something that we can be clear on. But we should be using our plans to help us both to make day-to-day decisions and key life choices, because planning for the future will help you understand what you can afford to do. Questions like, when can I retire? Questions like, can I afford to send my children to private schools? Or can I pass more wealth on to the next generation? Do I have enough? That's where modelling and planning is really important. And that's something that we think is critical to wealth management and helping people achieve their outcomes. It's that question that needs to come first, and then you decide where to invest. And then our process, as Jared and Ian has talked through, is designed to help you get the best returns at the lowest cost that we can. That's where some of the things that we control come in. Time in the market. It's tempting when cash rates are higher, for example, and there's all this uncertainty to try and time coming out of markets into cash, back out into markets. It's extremely difficult to do. If you're sitting in cash, for example, now thinking I'm getting 5%, the risk is partly that when that 5% in a year becomes 4% because interest rates have moved, but also that if you're going back into markets, if you're doing that in an area that should be invested, the risk is that the market move's already happened before you rotate back in and you don't get that timing right. Because if we take equity market returns, for example, we might expect them to give 6.5%, 7% per annum over time. They don't come in straight lines. And you might get 20% in one year and minus 10 in the next year. And if you miss that 20%, it makes a huge difference through time. To make it more palatable, you can definitely think about diversification to control the risk that you have, to smooth that path of return through time. And that's something that our portfolios are all designed to do. Other things you can do, all for other things being equal, are using tax allowances and planning sensibly about which different wrappers you save into, which ones you draw through time, and the minimization of fees. All of you are probably familiar how important fees are, why we really focus on that and making sure that we keep them as low as possible, because that gives you the best chance of getting better net returns into the future. But what I wanted to touch on briefly was tax rates. As we think of 23, 24, the tax year we're in currently, there have been some changes that have happened. I'm not going to go through each one of these one by one, but the main thing to note is that the thresholds have maybe been frozen or in fact reduced through time, so that the income tax that you're likely to pay is probably all other things higher this year than it was last year, because we've seen inflation, so you might get more income, but the bands have stayed the same, so it's a sort of stealth tax to be aware of. Capital gains tax allowances are coming down as well, and the same for dividend allowances. The same is also true for IHT. All of this, what this means is it's even more important to be taking actions, doing the simple things you can to mitigate tax where it's relevant, whether that be about planning for the future and gifting assets out so that you avoid IHT, or just making sure you're using all your allowances every year, using your ISA allowances, saving into your pensions as well, to make sure you're getting the best outcomes possible. Because governments, whether it be this one or a future government, are looking at ways to increase their revenues as well along the way. And pensions is another area where we saw a lot of change this year, but it's something to think about as we go into the first quarter of 2024. That's the last part of the tax year. Are there things you can be doing? We saw the annual allowance increase this year for pensions to 60,000 potentially for some people. And we've also seen the level of tapering move up as well. So tapering is the idea that an annual allowance will reduce for those that are the highest earners. But the threshold it kicks in at has increased. And it's something to keep in mind. And even for some of you that might be a higher earner and think you can't put much in your pension, the minimum level has increased to £10,000. So it's worth taking a look at that as well. I think the other thing to notice and think about here is for those that have been impacted by increases in the tax rates that are coming about because you're moving through the bands, pension contributions can be a great way to get that tax back. And I wanted to help you think about this relative to some of the other choices. So I talked about interest rates rising. And when you're thinking about whether you should be paying down a mortgage or thinking about planning for the future, those are sort of two different, potentially long-term goals, paying off your mortgage and planning for your retirement. And how do you consider that decision in the short term? Well, having a financial plan and speaking with an expert can really help you do that. But this chart here is designed to show you it's not always as obvious as you might think. This example here looks at the net benefit of a £10,000 net pension contribution versus paying down a 5% interest rate over 20 years on a mortgage. So this assumes the interest rate stays at 5% for 20 years and that you pay a £10,000 pension contribution, you invest it. When outside a pension, it's tax-free. So you're getting the benefit of tax-free investing over 20 years. And when you take the money out, you can have 25% tax-free. And also, you're going to pay income tax on the other parts. Even considering that you'll pay the tax rates the same on the way out as you put in, you can see here the benefit is that there's a positive benefit for basic rate, higher rate, and additional rate taxpayers to making those pension contributions versus paying down a mortgage. Now, that's not saying you shouldn't pay down the mortgage debts in some instances, and it's likely for most people's plans, and it will depend on your circumstances, blending this is relevant. But it just highlights they're not necessarily always as obvious as you might think. And it's important to talk to someone about what the right plan is for you and how you can balance your different goals. Another technical point that I know we had some questions on in particular was around the lifetime allowance. It's something that is relevant to certain people with larger pension pots. Historically, there was a tax charge to be paid for people that exceeded the lifetime allowance when drawing benefits or reaching age 75. Currently, in this tax year, the interest rate is 0%. From next year, there will be no lifetime allowance. Now, that might present some interesting opportunities for people to consider. Those that have pension protections can also make contributions without losing that protection, which historically they couldn't do. So again, there might be something for them to consider depending on your financial plans. And I think the key here is that you probably need to think through this not as an individual decision, but in the round of your plans. And that's really what we would love to do with you as you go into 2024. Have conversations about how we can help you. We've got tools to help you think about the future and go through those different moving parts. There's some nuances that are certainly worth looking at before the tax year end to make sure you're making the most of the allowances and making sure you're aligning with your plans. Another part I just wanted to highlight, something that we launched this year, is for those that are going to hold cash, And if it's right to hold cash, potentially in a taxable account outside of a pension, or even if you are really, because you're uncomfortable with market risks, going to hold cash in other places, it's important to make sure you're getting returns where you can. So that's why we updated our risk level 1 portfolio, calling it our liquid reserves portfolio. We noticed that a lot of platforms, you may have seen some headlines yesterday about some of the DIY platforms not passing on cash rates to investors. They've adjusted that a little bit in the last couple of days, but they're still probably passing on things like 3%, where the cash rates really should be closer to the base rate, which is 5%. The banks are certainly not passing that on. So our risk level 1 portfolio it's not cash, but it's looking to target cash-like returns, give daily liquidity, to be diversified as well. And it's currently giving a gross yield in sterling of 5.3%, which I think is potentially something to be considering. This isn't to replace your current account. There's amounts of money that you need every day. But if you're going to hold cash for a slightly longer time period, it's key in the current inflation environment that you make sure you get as much return as possible. So if anyone wants to find out more about our liquid reserves portfolio, please do email us at advice@netwealth.com, so it might be something that's appropriate for you to consider. Now, I'm conscious of time. We said we'd get to questions. So what I want to do is bring Jared and Ian back in to the conversation and now have a little moment for questions. We've got quite a few different questions about interest rates and inflation. And one in particular I thought we could just start with, and perhaps this is one for you, Jared, but with the view that inflation will be higher in the future, perhaps 3%, how do you think interest rates will move, particularly in the UK, and what sort of level would you expect them to be bottoming out at?
Okay, thank you. Well, the key issue in the UK is that the Bank of England still has a bias to tighten in some respects. They're pretty hawkish, voting 6-3 today, but 3 of the members still wanting to push rates up. Notwithstanding that, I think rates have peaked. So the question is when they fall, how quickly they fall, and as the question asks, what level they fall to. Before the pandemic, the Bank of England, like other Western central banks, thought R-star, which is policy rates after allowing for inflation, was close to 0. That would mean inflation of 2% would mean policy rates at 2%. If inflation was 3%, policy rates should be 3%. So the bank and the Fed are still sort of thinking that R-star, so to speak, means that neutral rates can still be far lower than they currently are. If inflation was to settle at 3%, the immediate question then is, does the bank go the extra step to try and get inflation down by squeezing the economy further? I think by 2025, which is when this debate will be very much in full flight, I think there will be some acceptance that you don't want to kick the economy too hard. But policy rates, in my view, should, even though I think they're too high now and they should fall, my feeling is that ideally you want to see policy rates settling at a much higher level in the future, around 4%. But I think central bank thinking suggests that the markets will think policy rates can settle nearer 3% or so. But I think that debate is yet to be had. I think that nominal GDP should be the determinant of where interest rates settle. So if you have growth of 1% and inflation of 3%, add 1 plus 3, you should get rates at 4%. If you have growth of 2% and inflation of 3%, then you might even say it should be higher. But I think the gist of it is that rates will fall next year. It's unclear where they will settle. Current central bank thinking hasn't really altered from before the pandemic. Markets are starting to factor that in, that policy rates will then fall to levels nearer to 3% if you look into 2025 or so. But I think what we need to avoid is going back to the problems that cheap money gave us before the pandemic.
Thanks, Jared. In fact, I mean, this is kind of the key point, isn't it? That what we're experiencing now, a cycle where interest rates rise and then they come down again, reflecting the different moments of economy, is the more normal scenario. What we experienced over the last 10 plus years, where we just saw one direction of monetary policy, is the abnormal. And maybe that plays into one of the other questions we've been getting, which is really around fixed income and what is a normal level of return, but also the role to play of them. What I thought, Ian, actually a way just to bring together some of the questions you've had is a debate that's come up a lot, which is about balanced portfolios. We've had lots of talk about whether we'd seen the death of a 60-40 or a 50-50 portfolio. How is your feeling about the role of a balanced portfolio going forwards?
Yeah, thanks, Matt. I think the important thing to notice is that the repricing of fixed income, the volatility that people have seen that has prompted those questions around the death of the balanced portfolio, is now what is likely to be supportive in future months, coming quarters, and more importantly, from our point of view, coming years. So from a strategic point of view, and we make a bit of a difference here between thinking about things on a more cyclical basis, like the direction of travel of different central banks, etc., versus a strategic outlook of how much embedded value there is within a different asset class, and what you can pick up as that ongoing market premium. And that the chart that I showed earlier is really anchors our view on this, that if you can get a 2% inflation adjusted yield on the safest of asset classes in the US now, that's a great starting point for other asset class returns to key off. And so the expected returns are therefore that little bit higher. Now, cyclically, you're certainly going to see periods where people call those returns into question, because we're moving at this transitionary period, means there's going to be a little bit more volatility in there. But there's nothing inherent in fixed income markets at the moment that would suggest they shouldn't be an important part of portfolios. And what's great, and the key point that Jerry mentioned earlier, is that these moves have given room for maneuver for central bankers. So if there's growth disappointment, they now have the scope to adjust monetary policy accordingly to adjust things.
That makes complete sense. And it makes me think through, from a planning perspective, the importance of thinking about your goals, matching up your risk profile, and not getting too tied up in the rear view mirror. So looking at what's happened in the past and that driving how you allocate. Think about what you're trying to achieve, make sure you're allocating the right type of risk profile. And then if you're not sure how to make that portfolio structured, you can rely on people like Jared and Ian to build portfolios for you in a way that should give you those returns through time. And a lot of it is about making sure you match up that time horizon with that level of risk to get those market returns. So some other questions that have come through. We've got a couple of planning ones, which I'll touch on in a moment, but just to stick with the sort of monetary policy part, there's a few people asking about the Fed meeting and minutes yesterday, what that means. Should we be expecting more positive market moves? We saw a bounce yesterday. Is this something that we can expect to continue in the short term? Jared, I think you're muted, but we can. There we go.
Am I unmuted?
You're up now.
Yeah, I watched the Fed press conference last night. On the positive, from our perspective, I thought that Powell, the Fed chairman's comments, very much fitted with our theme of a shift from a focus on inflation to a focus on growth, reiterating the points I made earlier. The markets in recent weeks have basically convinced themselves that the Fed had peaked. And then the markets in recent weeks have been talking about the pivot to rate cuts. The Fed, in contrast, up to 2 weeks ago, was saying it was pause, not pivot. So we agreed it was peak. The clash was between markets saying pivot, let's cut, and the Fed saying no, pause. Last night, Powell basically endorsed what the markets have been saying, indicating that there would be a pivot. There were a few aspects of his press conference that haven't really been picked up in the media today. One in particular was he said, we have a dual mandate. We've been focused on the inflation mandate. Now the dual mandate of inflation and employment has come to the fore. At the same time, he did say growth had disappointed recently. So he's very much of the view that inflation is really coming down, decelerating. They're still not sure where it's going to settle, but it's very much it's growth that we need to focus on here. Now, that suggests that the markets are right to be factoring in rate cuts next year. Maybe we could get the rate cut as early as March. Prior to last night, we thought that there would be easing by the Fed next year. Now it seems that easing could be sooner and could be greater. But it's very much reflecting the fact that the Fed is picking up that the data shows inflation decelerating, growth is weakening, and importantly, to conclude, as Powell touched on, it's taken on board the balance of risks. Monetary policy tightening has really impacted in the last few years, but takes a long time for that policy tightening to feed through, and some of that is feeding through. Now we're starting to have easier financial conditions come to the fore, and the Fed is happy to endorse that because it thinks growth is a worry.
Sense, as you say, it's always nuanced, and lots of different things to keep keeping in mind. Moving to our financial planning question, we had one here that says, is there a rule of thumb to adopt when making a decision between paying off a mortgage or investing? This is a great example of where there are rules of thumb and they're sensible, but the devil is in the detail and there's nuance to it. So the rule of thumb generally is paying down debt is a good starting point. You get a guaranteed return. If you've got a 5% mortgage rate and you pay that down, you've made 5% versus not, and that's guaranteed. And you won't pay tax on that return as well. So that's a pretty good starting point to think about. But for different individuals with multiple objectives and goals, there might be arguments for blending that. So I showed that those tax rates before and the benefit from a pension as an example. There are even more extremes elements of that. If someone's earning just over £100,000 a year, for example, they start to lose their personal allowance and their effective tax rate is 66%. Then it can be really beneficial to make pension contributions. To meet some of your other goals in the future, it may be appropriate to keep some money back rather than having it all in your property as well, and for diversification. So I think you can follow simple rules of thumb and they will help you as much as possible. So it's that time in the market, being diversified, making the most of tax wrappers are all simple rules of thumb. But the benefit is really to make sure you think about your wider plan and join that up. So we have a number of services you can use to avail for that. You can speak with advisors anytime you want. We've just recently launched something called our Financial Planning MOT, which is designed to help you think about all the assets you've got and your plans for the future and these kinds of nuances. Or you can always take financial advice, whether that be one-off or an ongoing basis. And we would encourage people to explore this a little bit more. Getting the detail right can really make a big difference, irrespective of what happens in markets through time. I'm really conscious of time. We're pretty much coming to a close. Thank you so much, everyone, for joining. As I mentioned before, there will be a recording. As you leave the webinar today, there'll be a short survey. It'd be great if you could take a moment to fill that out. And if you do have any further questions, please do send those through to advice@netwealth.com. But I want to say thank you to Jared and thank you to Ian for joining us today. It was great to go through some of the things to be considering for 2024.
Thank you. Bye-bye.
Thank you.